Hmm. Is cost segregation study worth it for your rental property? By the end of this video, you will learn from Yonah Weiss, a cost segregation expert, how to determine if cost segregation is worth it for your residential real estate property or your commercial property. So you can go ahead and save some time and money. If you're a passive or seasoned investor or even a beginner one, you can find the best real estate strategies, innovative ideas, and real estate concepts, advice, and tips from experts on this channel. So go ahead and hit the subscribe button below so you can get notified when I post a video every Wednesday. My name is Maldonado, and I have been involved in the acquisitions of non-performing notes, rehabs, multifamilies, extended stay motels, residential development projects, and other private loans that total around $70 million in assets. I'm one of the founding members and executive of the fastest women real estate network, Rent Inspires, and I have the honor of helping thousands of passive and active investors not only to create wealth, but to overcome the #1 challenge of most entrepreneurs, access to capital. So let's go and interview Mr. Yonah Weiss so we can learn if cost segregation is worth it for you. Yonah, I want to welcome you and really thank you for taking the time to join us and share your knowledge and your expertise. And talking about expertise, from everything that you could pick up from taxation or income taxes, you decided to become a cost segregation expert. How did that happen, and how Yonah, and why cost segregation?
That's a great question. You know, it's a long story. So I know we have like 3 hours here, so I'll go through the whole thing if you really want. But really, I was a teacher before I got into real estate, and I was at a certain point, I just needed something else to do, something not because I was bored, but because income of a teacher is not really great. And my wife was, a lot of kids, thank God, and I'm very blessed. And she's a homemaker, she stayed at home. She worked, for a certain number of years, and then we decided, it's best for her. So I figured, hey, let me go and see what the world can offer me, and came into real estate. Now, cost segregation came about really almost accidentally, and I say accidentally because I don't really believe in coincidences. I really believe everything is divine providence. Everything comes from above, but I had no idea what cost segregation was before I actually got into the field, because I went to work for this company, which is Madison Commercial Real Estate Services, and they have a number of services for commercial real estate, one of them being the biggest cost segregation company in the country. And I was like, hey, this sounds amazing. I learned about everything they do, with title insurance and 1031 and everything. I was like, this sounds like the best. Why? Because what I love to do are two things more than anything. My biggest passions in life are, #1, teaching. And #2, helping people. Like I, started a nonprofit many years ago to help. It's just something my nature is doing that. I was like, hey, this is just helping people save taxes. Sounds great. You guys are the experts. Let me learn from the experts on my team, right? The company, Madison. And I was like, I'll be able to conquer this and become the expert on this, so I can teach everyone else about how to do it. So that was, in a long story short, that's how I got into it.
Wow, that's awesome. I didn't knew you were a teacher. That's amazing. And that would explain your passion about sharing your knowledge with everybody, because I think that's one of the things that I admire the most from you, your passion to really educate people. And, I honestly, when I started investing in real estate, I started with residential properties. But then it's not until I got into multifamily and extended stay motel models that cost segregation was some kind of a popular topic. And for those people that do not know what is cost segregation, what does cost segregation mean?
And I before I define that, I will just reiterate what you said there. Most people who are in residential don't know about it. And so that's the
Mm-hmm.
great thing. Once you start getting bigger, you learn about it. And I like to teach everyone so that even if you're starting in residential, you know the concepts and you'll be able to apply it when it is relevant. So cost segregation is really just an advanced form of depreciation. Depreciation is a tax deduction that you get because you own a property. The IRS gives you this great tax deduction. Cost segregation is just taking the cost of the building and segregating the cost. Well, okay, what does that mean? We're breaking down the cost into different categories, into different elements. So instead of lumping the entire building, and regular depreciation deduction will allow you to take that cost and take a small deduction every year for 27 and a half years or 39 years. That's what depreciation is. You get, a tiny income tax deduction. Cost segregation allows you to break down the property into different categories that actually depreciate faster, which increases your deductions in the earlier years and increases your cash flow because you have pay less taxes. So essentially, that's what we're doing.
Oh, wow. I think that's one of the simpler explanations I ever heard about cost segregation. I know that all the geeks out there from real estate and saving taxes, they get into these complicated definitions, but I think you lay it out pretty well. It's just an acceleration of tax deduction. But let me ask you this, what are the advantages a part of a tax deduction? Why do I really want to go into cost segregation and accelerate my, let's call it write-off, if I can call it technically that way?
The main reason real estate gives you this ability is the game of real estate is long-term wealth, right? It's not a short-term, right? It's investments. Investments are long-term. People may doing short-term fix and flips and you'll get something, but the game and the goal of it is really to build upon itself. Whether you're doing short-term holds, whether you're doing residential, whether you're doing commercial, it doesn't matter. It's a long-term game. That's really, everyone knows that, real estate is taking, it takes time to really build that wealth. Now, with the tax deductions that you're allowed to take, it allows you to accelerate that process, meaning to build that wealth faster. So think about, just an example. If you had $50,000, how much could you buy with that $50,000? And let's say you had $50,000 every single year for the next 5 years. Okay. How much could you do with that? Okay. Only a certain amount. Okay. Well, what happened if you had, $100,000 every year for the next 5 years? How much more could you do with that? And so a person who's able to understand the value of cash flow and understand the value of how much, the more cash I have, the more capital I can buy, the more spending power I have. And especially when using leverage, when using loans from banks, the real estate allows you to do, just put a small amount down and get the rest from the bank. That's buying power. So the more cash you have, the more buying power you have, the more you can increase that. And so when you have next year even more, and the year after that, it builds upon itself. So that's really the main reason why you want to accelerate that depreciation, get more deductions as you can earlier on, because that just allows you to push forward, have more cash, more buying power, which compounds itself to how much more you can create over a longer period of time.
Now, I think you are tapping into very important point when you're talking about building wealth with real estate. I mean, everyone here from all of the famous programs out there about fix and flip, which is just one of the strategies. But if you really want to build wealth with real estate, one of the strategies that we use is what we call buy and hold, right? Where we decide to hold a property, and that property can be a residential property or it can be a commercial property, right? Multifamilies and hotels or everything that falls on the commercial. Let me ask you this. When I'm making my decision about if I should do a cost segregation study, does it really make a difference if I am planning to hold the property for 5 years, 6 years, 7 years, or maybe 15? Does that affect my studies? Are there any advantages on holding it for a longer time, or what's your advice on that? And I know it depends on the individual person too, but yeah.
Right there, and there's a lot of factors that come into this. So I want to just lay out a few things just to maybe understand this a little better, because, and I may go into a little more detail. You mentioned very kindly that's the simplest explanation of cost segregation before, and it really, I try to do that. But to really understand a little deeper, I can go into how it works more in the mechanics. But before we get to that, just to answer your question, and it depends. Really, that's the answer. But one thing that you need to know is that it depends more than anything else on the individual, on what their game plan is, what their business strategy is, not just the hold period of this property, but overall on any number of properties. But how many properties are you buying? Is it just this one, or do you have a plan, and are you constantly buying, every year, 1, 2, 3, etc.? And the reason why I say that is because, like I mentioned, depreciation is this great tax deduction that goes against your income tax. But income tax has different categories. One category is rental property income. Okay, so if you own properties, that rental property income is considered passive income. Guess what? Depreciation is used as a passive deduction to offset your passive income from your rental properties. However, and that actually goes across all of your rental properties. So if you have, let's say, 5 properties, and you're making, let's say, $10,000 from each of them, just to keep it simple, you have $50,000 of total net operating income across your 5 properties. Now, if you have depreciation from one of them, you do a cost rate on, and you get a $50,000 tax deduction, well, it's going to offset not only the $10,000 from the income of that property, but also the $40,000 from the other rental property incomes. However, what happens if you have, do a big cost segregation study and you get $200,000 of deductions from bonus depreciation, right? What happens then? You only have $50,000 of income. That extra $150,000 of deductions, it creates what's called a passive loss. It means if you are a regular, Joe, regular Jill, you don't have any other, you're just a working person, you're not a full-time real estate professional, you're limited for depreciation to offset the income from your properties. However, and I'm building up here, so just bear with me. We're doing a few different things over here because I want you to understand these concepts. If you have, and maybe if I had a whiteboard, it would be easier here, but if you're a real estate professional, which is a status with the IRS that allows you to take those extra deductions to offset any ordinary income that you or your spouse may have beyond the rental property income, then that extra $150,000 can now be offsetting your other income as well. So you ask, how long should a person be holding it, and will that make a difference in terms of their hold period? The answer is yes, it will make a difference, especially if you have more than one property. Because if you have just one property, then you're going to get that maximum benefit within the first 5 years. Okay? And then after that, you're going to have less depreciation deductions. The benefits are going to be less. However, if you have more than one property and you're constantly buying, then the depreciation from one can then be used to offset income from the others. And each one will kind of move down the road, and you're building up from one to the next. And so in that case, it really doesn't matter, because as long as you're constantly buying and using depreciation to offset your income, then it doesn't matter how long you're holding properties for.
That's very interesting now that you mentioned the different components. It looks like if I'm trying to make the decision if I should do a cost segregation study or not, I need to decide, first of all, as you mentioned, do I have a job, and does it really benefit me? It looks like the holding time might be another factor. Are there any other factors that we should consider when deciding if we should do a cost segregation study or not?
One of the main factors is to see if you can actually benefit from it, okay? Because again, like we said, creating tax deductions is only good as long as you can use those deductions. So the first thing to check, your box is, number one, are you a real estate professional? Then if you are, then you're for sure, it's almost going to be a no-brainer. You're for sure going to be able to use those deductions. But even more than that, what we always do is run a free analysis. And again, I work for the largest conservation company, so just that transparency here. We run a free analysis, which will allow you upfront to know if it's beneficial or not. So you'll know already, even before you go through with it, if this is how much tax benefit am I going to get? So that's really going to be the main deciding factor. And then you can understand, based on your situation and your business plan, should I be doing this or should I not be doing this?
Yeah, that's awesome. So it sounds that the most simple way to handle this is, for the audience out there, guys, just comment below if you would like to have maybe Yonah answering the question, is it doing a cost segregation worth it for me? I know that sometimes there are some parameters to Yonah on the price of the property, either if it's residential or commercial. Is there's like some basic guidelines that can help people decide if they should do it or not?
Absolutely. The main guideline is, my rule of thumb is usually any property purchased for over $500,000 is really where you're going to start seeing a 10x benefit from your investment. And the investment, I mean, is the amount you have to spend on actually paying for the study to be done, which obviously it's a service, it costs money. This is the biggest benefit. Okay. Once you start getting smaller than that, and this is probably why, Jen, you mentioned, when you're residential properties, you don't really know about this. It's not brought up in conversation. Why? Because it's not that beneficial at that point. And because, as I mentioned before, your tax basis, the amount that you can deduct of depreciation, is based on your purchase price when you buy a property. And this is a great thing. I'll interject here. Just something I love to say, just to describe to you how you understand what depreciation is and why it's so beneficial. It's like a hypothetical deduction. What I mean by that is, it's not really based on how much the property is worth or how long it's been around for. If you buy a building that was built in 1924, the day you buy it, you get to now start over your depreciation deduction for 27 and a half years based on the purchase price today in 2020, which is incredible because it's hypothetical. It's not based on the actual depreciating, right? The value of the building itself going down. It's totally relative to you as the buyer. And that's what's most great about this.
That's awesome. I mean, I start learning a lot, and I have to share this story with you. I do love taxes and understanding the concept. Not that I will ever dare to be a CPA or a tax advisor, but at the same time, I just love to have communication with my advisors and understand their language, because you guys have like a big dictionary. Now, the reason why I'm sharing that I was trying to learn about cost segregation is I was asking myself, can I do my own cost segregation study? Or should I hire a company like yours or someone like you to perform these kind of studies? Can you share a little bit about the pros and the cons about doing it myself and, compared to working with someone like you or a company that specializes on these specific tax strategy?
Absolutely. There's, what I like to say a lot of times is that if you are an expert in everything, then you're really an expert in nothing. Mm-hmm. And so to be an expert in one thing, you have to find experts in other areas to help you, to support you. And, the IRS is not the easiest to deal with. Okay. So anytime we're dealing with taxes, you want to make sure that everything, all the boxes are checked, everything is compliant, everything is totally done. So cost segregation is no different. Okay. It was invented and regulated by the IRS. You can go to the IRS website and find what's called the Cost Segregation Audit Techniques Guide. Okay, that's gives you all of the rules and regulations in what goes into creating a cost segregation study and what needs to go into. One of the things that needs to go into it is that it must be prepared by someone who is qualified. okay, and has the experience in not just construction and engineering. As I mentioned, the main element of a cost segregation study is not the taxation part of it. That's just one aspect. It's really the engineering component. And so this is something we didn't really discuss so much, but as I mentioned at the beginning, the breaking down of those costs into segregating the costs into different categories is done by an engineer who not only understands construction engineering and says, hey, there's X amount of cabinets here, there's X amount of square footage of carpeting, the fixtures, all of this, but also which category those fit into the tax code on the cost recovery system. So you need to have that done. And there's a whole list of, a whole numbering system, a whole nomenclature you have to use. You have to use facts and you have to have pictures. So basically, it's very difficult to do this on your own unless you have that experience and you make sure that you're following the rules set out by the IRS. That being said, there are many companies that specialize this. Most accounting firms do not do this. Even though I mentioned it's an accounting method, most accountants don't do this, which is part of the reason, in my opinion, why a lot of people don't even know about this. Because, let me ask you, when you hear something that's related to taxes, and you at home watching this, when you think about something related to taxes, what's the first thing, unless you are yourself, a tax nerd or accountant by yourself, right? What do you think about? The first thing you think is, let me speak to my accountant, or let me, I have an accountant for that, or, oh, this must be something, I'll check that. I'll discuss this next time I have a conversation with my accountant. So it's not necessarily something people are going into themselves and figuring out themselves and doing themselves. It's something that taxes, the mind automatically accountant, right? It's not. That being said, cost segregation is something that accountants don't do. Remember, it's an engineering component. You need an engineering firm to do this. So therefore, your accountant's not going to tell you about this, most cases, in my experience. So even assuming your accountant's going to do this, or then having that conversation with the accountant, and they're like, well, we can't really do this, or we don't do this, or whatever, a lot of people get stuck at that point, which comes back to that's why you need to educate yourself, find out how to go about doing this, make sure you have a firm, someone who's qualified to do this, and then you'll be able to get it done right.
Yeah, definitely. I mean, and you gave us so much information there in every aspect, from the point of where to find some guidelines, the reasons why you want to work with an expert, at least that you want to become an expert on cost segregation. I'm a little bit of a geek because I'm an engineer from profession, and sometimes I'm wondering how things work. But the moment that I open the book, I'm like, nope. But I think that you point out something very important, and it's working with the experts and educating yourself. Sometimes as investors, we tend to rely a lot in the accountants to know everything about a specific topic. And if you are not learning new information to go back and ask them, you are missing a lot of opportunities, like when to do a cost segregation study. And for me, that was a mind-blowing moment when I went to a real estate event and they talk about multifamily specifically, and they were talking about cost segregation. And as you mentioned, first question that came to my mind is, I need to talk to my accountant. And that's when I noticed that I had a good accountant, because although she's not an expert on cost segregation, she knew exactly how it works. She knew where she needs to put it in the taxes. And she told me, you need to hire an expert to do this, and I will be happy to work with them. So you mentioned, and now, I mean, we always have to be educating ourselves continuously. So I know that a lot of things have changed, and I'm curious if, with everything happened in the pandemic, the CARES Act, were there any new cost segregation tax law that changes that we need to be aware? I'm not 100% sure.
Sure. Excuse me. With the CARES Act, there was actually a couple of things that happened. One of them was actually a correction for something that was originally updated and introduced in the Tax Cuts and Jobs Act a couple of years ago in 2017. And that was the biggest change in real estate investing in general and cost segregation specifically that has happened in the last 30 years. And that was something called 100% bonus depreciation, which allows you to take all that accelerated depreciation in year number one. So that's taking a huge amount of, like I mentioned, 20%, 30%, 40% of your actual property value. You can accelerate that and spread that over a 5-year period, 15-year period, or with the 100% bonus depreciation, take that all in year number one. That's huge. Okay. We're talking $1 million property. You may be able to get a $200,000-$300,000 deduction in the first year. That's incredible. Okay. That's a side note. In the CARES Act, they made a correction, and this specifically relating to retail properties and restaurant properties. They made a mistake in the Tax Cuts and Jobs Act and excluded certain things from getting the bonus depreciation. And so they made a correction, and now you can do that. Everyone else, multifamily, has been able to do it since 2017. It's been awesome. It's been the biggest game changer for people in real estate is this bonus depreciation thing. The second thing that happened that was really, really, really huge when it comes to taxation and cost segregation is what's called a passive loss carry back, or net operating loss carry back. As I mentioned before, if you have more deductions than you have income, okay, you create what's called a passive loss. You don't lose that money, you don't lose those deductions, but you can't use them this year. Usually what happens to them is they carry forward, which means that you use them next year. Whatever you didn't use this year, they carry forward. They're in like some imaginary, invisible bank account. And then next year you pull them out and you're like, oh yeah, I have extra deductions. I can use them this year and the next year, et cetera. They carry forward as indefinitely until you sell the property. However, they introduced something called net operating loss carry backs, which means if you have, or they reintroduced it, it used to be around, but they reintroduced it. If you have those passive losses this year and you paid taxes in the past 5 years, you can now go back, amend your previous year's tax returns that you paid taxes on and carry those losses backwards, apply them to previous year's taxes, and get a refund check to whatever taxes you paid in the past 5 years. And part of the reason why they did that, because obviously they're trying to figure out ways, how can we stimulate the economy? How can we get people more money? Here, this is a way. If you have losses this year and people that are operating at losses because they don't have businesses running in 2020 properly, for whatever reason, and for real estate specifically, it's just all the more helpful, you can now go backwards retroactively and get those tax refunds. So that's probably the biggest thing that happened in the CARES Act.
Oh, wow. I'm so glad I asked that question because I was completely unfamiliar. And I'm like, I wonder if there's something that happened also from the cost segregation perspective based on CARES Act. And it impacts many areas in financing and deductions. And I wanted to know how it impacts cost segregation. So that's awesome. So Yonah, one last question. Well, actually I have two more. The first one is, I defined, determined that I need to do a cost segregation. What is the process with your company to do that? And you mentioned first you can get a free kind of assessment conversation, but how does the process happen?
It's pretty straightforward. Like I mentioned, we usually reach out, take a few pieces of information about a property, usually look at the address, which our engineers will look at, the square footage, the number of units, how old the building is, et cetera, a bunch of things from the address that we will pull those records. And we'll look at the purchase price and we'll be able to run a free analysis. That's for educational purposes. Once you decide to do it, we have one of our engineers, okay, all in-house, either two options. Number one, come to the property. And this has been our business model for the past 15 years. We have engineers on site, taking pictures, walking the premises, creating this whole report based on that. But with the COVID situation, we had to pivot and we figured there's travel restrictions. We operate in all 50 states. Okay. We usually had engineers traveling all over the country, right? 16 engineers across the country, still traveling a lot. We had to pivot. What did we do? We created a virtual, what we call a smart site tour. So we'll have our engineers, wherever they're located, with a video conference, someone on site, a property manager, a maintenance person, someone who knows the ins and outs of the property to take them around, take the measurements needed, take the picture, zoom in here. Oh, what's that? Focus here. Oh, can you look up, down, etc. They take that video, take that footage. Either way, whether they're on site, and we still do the on-site visits where appropriate and where possible, whether on site, whether through that smart tour, the engineer takes all that information, creates this very detailed 80, 90, 100-page report. That's called your cost segregation study. And then in that produces a new depreciation schedule. That depreciation schedule, that one page, is what you now need to go and take to your accountant, and they apply that to your taxes. It's pretty simple, pretty straightforward. The whole thing from beginning to end usually takes a few weeks to turn around. And that's pretty much it. There's a service, there's a fee involved, not contingent on your tax savings, but a scope of work, involved depending on the size and scope of the property and the project, whether it's a new construction, whether it's a new hold, whether you're doing renovations. There's so many different options. Even if you bought a property this year, or you bought a property 5 years ago, you can actually go retroactively and get the tax benefits you missed and do a cost segregation, what's called a look-back study. So there's a lot of options to do. Whatever it is, we take care of it all, and it's a pretty seamless, pretty straightforward process.
Awesome. It sounds very, very simple. And I know we talk about this because we are in the middle of having some of those conversations, but it sounds like the first step is they need to communicate with you, right? So they can have that conversation. They can define if a cost segregation study might be worth it for them just by watching this video. Second step, they can connect with you. And at the bottom, I will put a link where you can just go directly to Yonah and chat with him once that you know that these might be for you. And then after that, you guys plan and coordinate to do the cost segregation study, create a report, and that's a report that you take to your accountant, and your accountant do your taxes. Sounds very simple to me. So now let me go to these two extremes. What is the most cost effective, or not cost effective, but what is the cheapest cost to do a cost segregation study you have seen, and the most expensive one? That way we can have an idea of the ranges that we can have. Sure. Right? We're
Absolutely,
budgeting for it.
100%. And like I mentioned, it's based on the scope of work. So I'll give you the two extremes, okay? If you have a multifamily property, really multifamily is one of the easiest to do because it's one of the only types of properties that the IRS allows the engineer just to go into one of each unit type. So if you have a 10-unit property and they're all, one bedrooms, it's pretty easy. If you have a 300-unit property and they're all one bedrooms, guess what? It's going to be pretty much the same amount of work on the 10-unit and the 300-unit. There's a little more because there's a lot of calculations involved there, but there may be more land improvements, there may be more, landscaping, et cetera, and roads and things like that. But typically between around $4,000 to $6,000 is how multifamily properties are priced. For us, again, we are one company. We're talking in 2020, it could be go up, go down. I don't know what's going to happen in the future. The larger the scope of work involved, and when you get into different asset classes like office or retail, shopping malls, for example, the engineer actually has to go into each and every single suite because they're different. And oftentimes each floor in an office building is going to be different. Every layout's going to be totally different. There's a lot more work involved in taking the notes and taking the intake of all of that, and then going ahead and producing the report on that. We've done huge skyscrapers. So take a 90-story 1.5 million square foot office tower, right?
Wow. Pretty big.
That's exactly right. The scope of work involved there is going to be something more like $30,000-$40,000 to do the work there, just in terms of the amount of hours spent. And that's pretty much it. But again, on a building like that cost $500 million to buy, and the tax benefits are going to be in the tens, if not hundreds of millions of dollars. It makes sense to pay a few thousand, $40,000 or whatever. Okay, you get the point.
Yeah, there's no brainer, right? And actually that's what I love about you, that right away you say, hey, this is going to make sense. You might be estimating, right, saving this much on taxes, so that makes sense. That makes sense to you. Now, one last question for you. from a business standpoint and a personal standpoint, what are you looking forward for next year, 2021?
I'm just looking forward to everything, because really no one knows what's going to be. And I love the fact that in new situations, you have to kind of pivot. You have to do things differently. And that's really where people can either kind of crumble or, and hide in a cave, or they can shine and they can, find out new things to do. For me personally, the biggest thing I'm excited for 2021 is that I'm actually right now, as we speak, working on my first ever multifamily acquisition as a co-sponsor. And so that's set to close at the end of November. So I'm really excited at that. And hopefully in 2021, that's going to bring a whole new area of life and, and opportunities that come with it.
Congratulations. I get excited every time I hear someone that says, hey, I took the leap of faith and I got into my first property. And it's funny because I always challenge the people that either service the real estate investors. I always challenge them why you are not investing in real estate, why you don't take a little bit of the medicine so you learn how does this work. And so congratulations for you, Yonah. And also I want to thank you for taking the time. I know you have a super busy schedule and you decide to come and join me and share all of these great knowledge with our audience today. So thank you so much, Yonah.
My pleasure. My pleasure. Thank you, Jen. It's been a pleasure speaking with you. And, I hope we get to do this again sometime. And I hope your audience got a lot of benefit from this.
Oh, they will. Believe me, they will. Now you know exactly the elements to consider to determine if a cost segregation study is worth it for your rental residential property or commercial property. I would love to invite you to join to my Facebook community, Invest with Jen, and you can find that link below. Also, if you like this video, give me thumbs up, subscribe to the channel, and share with your friends. See you in the next video.